At 3:59 on a Thursday afternoon, the execution router you spent 6 months coding gets manually disconnected by a server farm in New Jersey. You did not lose capital. You just did not generate it fast enough to justify your bandwidth. The automated email hits your inbox at 4:01 from an administrative account you cannot reply to. This is not the hedge fund from the glowing newspaper profiles. This is not the billionaire founder buying real estate in Palm Beach or the spectacular art collections. This is the industrial meat grinder that nobody puts on a billboard. Several hundred quantitative researchers, algorithmic traders, and data engineers sitting inside one of the most unforgiving profit engines ever constructed by human hands. Your career here does not end with a dramatic shouting match on a trading floor. It ends with a 2-millisecond latency delay on a Tuesday you can barely remember. Because the only thing that survives the climb is the climb itself. The meat grinder starts at the bottom. As a quantitative intern, you are 20 years old. The offer letter specifies $22,000 a month, 12 weeks, plus a luxury corporate apartment overlooking the Chicago River. You will earn more this summer writing Python scripts than your high school mathematics teacher will make in the next 5 years. The first week is not about finance. It is about total submission to the architecture. You learn that every single line of code you write is sandboxed, back-tested, and aggressively scrutinized by senior developers who do not know your last name and have no desire to learn it. You learn that the firm runs massive, distinct strategies across algorithmic execution, statistical arbitrage, and high-frequency market making, and that each one is compartmentalized so tightly that a catastrophic failure in one pod will not even make the screens blink in another. On Thursday of week 4, the intern sitting at the desk next to yours gets pulled into a glass-walled conference room. He does not come back to grab his backpack. You sit at your monitor pretending to debug a pricing algorithm, watching a security guard pack his mechanical keyboard into a cardboard box by 3 in the afternoon. Nobody explains the departure. Nobody apologizes for the disruption. The dual monitors still glow. The espresso machine in the pantry still grinds fresh beans. You start understanding the actual contract you signed. You just do not know yet that the people who deactivated his badge are not even in this time zone. Survival buys you a promotion to junior quantitative researcher. You are 22. Base salary is $175,000. Your signing bonus is $100,000, paid out on your first Friday. Your first year all-in compensation lands somewhere around $400,000, depending on the performance of the desk. You are assigned to a statistical arbitrage pod. The pod consists of a portfolio manager, 3 senior researchers, you, and a dedicated data engineer. 6 people controlling roughly $500 million in daily trading volume. You cover Asian equities. You log in at 8 at night to monitor the Tokyo Open. You parse satellite imagery of semiconductor plants, shipping manifests from Taiwanese ports, and alternative data feeds that cost the firm 6 figures a month. You learn that when you pitch a 40-page mathematical proof on market inefficiency, the desk head throws it in the recycling bin and asks for a C++ script that shaves 2 microseconds off a trade execution. The firm is not paying for your academic brilliance. It is paying for an actionable edge that lasts exactly 1 business quarter. You learn the concept of slippage. You learn that even when your directional bet is flawlessly accurate, the pod can bleed millions if the execution algorithm gets front-run by a faster competitor. A brilliant statistical model wrapped in slow code is just an expensive way to lose money. In late October, you build a predictive model for Korean tech stocks. It executes perfectly, capturing a tiny pricing anomaly thousands of times over 4 days. The pod generates $4 million in pure profit from your logic. Your bonus check hits your account in February. It is $85,000 after taxes. You stare at the balance on your phone screen. You think this is the definitive start of your empire. You do not yet know that the pod's profit and loss baseline automatically resets to zero on January 1st, and your next 12 months of existence will be measured against a blank slate. By the time you become an algorithmic trader, you are 25. Base salary is $225,000. Total compensation lands between $600,000 and $1.2 million, heavily tethered to your specific strategy's success. You now have direct control over a live execution book. The senior researchers still review your commits, but the portfolio manager expects you to manage the risk limits in real time. You walk into the Monday morning sync with a single printed sheet of performance metrics. The portfolio manager reads the top line and the maximum drawdown figure. Anything you put at the bottom of the page will never be acknowledged. Being mathematically correct is necessary, but it is not sufficient. Sizing the trade correctly under extreme volatility matters infinitely more than the elegance of your code. The firm aggressively tracks your Sharpe ratio. They track your win rate, your recovery time from a loss, and your correlation to the broader market. You stop going to happy hours with your college friends. You stop caring about their complaints regarding $50 bar tabs when your algorithm just lost the equivalent of a suburban house during your bathroom break. Your apartment in the Gold Coast costs $7,000 a month. You eat lukewarm delivery food at your desk while staring at order book imbalances. Your girlfriend stops asking what time you will be home, and then she stops asking anything at all. In early May, your portfolio manager tells you the pod is up 3.2% for the quarter, but the central risk software has flagged your strategy for excessive exposure to momentum factors. You do not fully grasp the severity of that warning. You will grasp it the following Tuesday when the automated risk daemon liquidates 40% of your positions 3 minutes before the closing bell, and you spend the entire evening helplessly watching your remaining alpha evaporate. The pressure compounds when you reach senior quantitative researcher. You are 28. Base salary is $300,000. Total compensation fluctuates wildly between $1.5 and $3 million in a standard year. You now run a sub-strategy. You are responsible for an execution book with over $100 million in gross exposure. You answer directly to the portfolio manager, but you own the financial consequences of your models in a way you never did before. If your slice of the pie drops 1%, the portfolio manager gets an alert on his phone. If your slice drops 3%, you are sitting in a sterile room explaining your failure to a risk officer who holds a doctorate in physics and used to run a pod exactly like yours. You begin to see the true architecture of the central risk apparatus. They sit on a completely different floor. Some are in New York, some are in London, some are just anonymous user IDs in the firm's internal messaging system. They do not build models. They do not pitch ideas. They watch. They calculate real-time value at risk, liquidity constraints, beta exposure, and the aggregate leverage of the entire institution. In September, 2 highly profitable pods on your floor are suddenly unwound on the same afternoon. One of them is managed by a guy who built a fixed income model you deeply admired. He had been generating massive returns for 6 years. By Friday morning, his name is scrubbed from the internal directory, and the ergonomic chair at his desk is empty. Nobody on the floor speaks about it. You finally understand that the firm's legendary unbroken streak of market dominance is not built on nurturing geniuses. It is built on the machine's cold willingness to to amputate the geniuses the second their risk profile threatens the host. You make a mental note to stay under the radar. You think the system will protect you because you understand it now. 2 months later, you find out that understanding it is not the same as outranking it. You can build all the predictive safeguards you want, but inside the firm, no one is coming to save you. Crossing the threshold to systematic portfolio manager changes the game entirely. You are 32. Base salary is roughly $400,000. Your contract now guarantees a direct payout, typically between 12 and 18% of the net profit you generate after the firm deducts charges for server compute, data licensing, and risk overhead. You now run your own pod. 6 people, including you. Your starting capital allocation is $500 million in gross exposure. Your employment contract contains a hard stop-loss trigger at the pod level, with exact percentage thresholds negotiated by your lawyers before you signed. Long before you even approach that hard line, the central risk algorithms start suffocating your book. The first month, your pod clears $8 million in profit. You spend the second month explaining to your wife why you cannot fly to Tokyo for your anniversary. You sit at the head of the pod and watch 5 brilliant engineers stare at the same market data, waiting for you to make the final call on a new deployment. Some mornings you have an answer, some mornings you do not, and you cover that fact by muttering about latency arbitrage constraints and microstructure decay until they stop asking. In November, your pod is up 8.5% for the year. You think about the payout. You think about buying a stone estate in Lake Forest. You think about the look on your family's faces when you secure generational wealth. The fantasy lasts exactly 45 seconds. Then you go back to monitoring the European bond yields. In December, a massive macroeconomic shock hits the currency markets. Your statistical models misinterpret the volatility. You give back $32.5 million in 2 hours. The central risk team automatically cuts your leverage in half before you can even manually intervene. You spend Christmas Eve in your home office running historical simulations while your family opens presents downstairs. Your year ends up a meager 2%. The bonus hits in February. It is a fraction of what you had already spent in your head. The pod survives. You survive. But the illusion is shattered. You have learned the ultimate lesson of this industry. You do not actually own your strategy. You manage it. The firm owns it. The firm decides when the game stops. Ascending to partner or global head of strategy places you in a different stratosphere. You are 38. Your employment contract is a bespoke legal document that most executives at the firm will never see. In a volatile, highly profitable year, your total compensation can land anywhere between $15 and $40 million, heavily dependent on the capital deployed and your personal leverage in the firm's hierarchy. You run a massive sleeve of the business, overseeing billions in gross market exposure. You have 4 portfolio managers reporting to you, each managing their own isolated pods. You no longer debate the merits of a single algorithmic trade. You debate how much risk budget to allocate to high-frequency market making versus statistical arbitrage over a 3-month horizon. The firm has stopped treating you like a disposable employee and started treating you like a franchise tenant. Pay the exorbitant rent in alpha, and you get to stay. You attend an exclusive off-site strategy meeting. It is not held in a flashy Miami hotel. It is held in a heavily guarded, unmarked lodge in the mountains of Wyoming. There are 22 people in the room. You look around at the faces sipping sparkling water and realize that the individuals at this table control tens of billions of dollars in deployable capital. There are no slide decks. There is only a brutal, surgical discussion. The chief investment officer sits at the head of the oak table and asks exactly one question per person. Yours is about the decaying Sharpe ratio of your top 3 quantitative models over the last 4 quarters. You do not pretend to know the numbers. You recite them perfectly from memory. You realize, halfway through your answer, that the question was not actually directed at you. It was a warning shot fired at the portfolio manager sitting 3 seats to your left, whose pod has been bleeding cash and whose name is already on a termination list you cannot access. In April, your overall sleeve is up 12%. But your top-performing portfolio manager has just been aggressively poached by a rival firm for an 8-figure guaranteed contract. You spend your day not on markets, but on people, calculating exactly how much you need to pay the guy on desk 4 so he does not take his $30 million alpha model to Jane Street. You spend a week negotiating with human resources to keep him. You lose. The replacement you hire takes 14 months to rebuild the infrastructure. Your sleeve gives back 5% in the 4th quarter. You do not get fired. You get a very quiet, very terrifying steak dinner with the founder. The final evolution is the management committee. You are 46. You no longer have a trading book of your own. You oversee an entire quantitative division. The number of engineers, researchers, and traders who report up through your vertical numbers in the low hundreds. The number of individual pods under your umbrella sits somewhere between 20 and 50. Your compensation is completely divorced from a single winning trade. It is based on the aggregate risk-adjusted return of the massive machine you supervise. You are paid in a hidden equity band that the financial press can only speculate about. You spend your entire existence managing human psychology and capital constraints. Who is burning out? Who is secretly interviewing with a competitor? Which pod needs a massive injection of server space, and which one needs to be starved of resources? Which portfolio manager has been hiding a structural flaw in his code for 6 months and is one bad inflation print away from a catastrophic margin call? You are the closest thing to a genuine decision maker in an ecosystem that has deliberately engineered itself to require fewer human decision makers every single year. You can hire the best talent on earth. You can fund their wildest ideas. You can starve their worst ones. But the one thing you absolutely cannot do is override the central risk architecture when it decides to kill a strategy. You tried it exactly once, 3 years ago, on behalf of a brilliant portfolio manager whose drawdown was breaching a hard limit during a flash crash you knew would reverse. You went to the risk floor at 9:11 in the morning and made a passionate, logical case to the head of risk. The automated liquidation happened at 9:14 anyway. That is the exact moment you understood who actually runs the firm. There is a floor inside the main headquarters that you have probably never swiped into. The security badges require a different clearance level up there. The desks are eerily quiet, lacking the frantic energy of the trading floors. The people on this floor do not have trading books. They do not generate direct profit and loss. They do not appear in the glossy magazine profiles about Wall Street titans. Most of them have doctorates in physics or computer science. Some of them used to be portfolio managers and chose this path instead. They are paid incredibly well, perhaps not portfolio manager well, but well enough to never leave. And they wield a silent, absolute power inside the firm that nobody on the trading floor ever fully accepts. Because to accept it is to accept that you are not the product the firm is actually selling. The firm is selling them. They are the central risk team. They run the autonomous liquidation engines that calculate in microsecond intervals the catastrophic failure probability of every single algorithm across every asset class. They calibrate the kill switches. They set the absolute mathematical boundaries of leverage. They decide which pod gets the fastest fiber optic route and which pod gets routed through the slower backup cables. They dictate the speed of light for the entire company. When they push an update, your trading screen does not flash with a warning. Your algorithm just stops winning. They are the reason the firm can execute billions of shares a day without collapsing under its own weight. They are the reason the firm survived the extreme volatility spikes of recent years when half the algorithmic funds in the industry blew up. They are the reason a 46-year-old management committee member who has just been told his best pod is being throttled cannot in any practical sense fight back. There is no executive level above them. There is no promotion track from portfolio manager to head of central risk. The risk team is not the top of the hierarchy. The hierarchy of traders sits on one axis. The risk team sits on a completely different axis entirely, and it underpins every single level you just sacrificed your life to climb. The chief investment officer can fire a $500 million pod in one afternoon. He rarely needs to. The risk architecture starves it first, and the chief investment officer simply signs the severance paperwork after the fact. This is what ambitious graduates miss when they look at this firm from the outside. They think the firm is a collection of brilliant, irreplaceable quantitative minds. It is not. It is an industrial system designed so that no individual mind, no matter how brilliant, can survive being wrong about the market's physical constraints for longer than a few milliseconds. The quantitative researchers are entirely interchangeable. The system is not. That is the only thing inside the firm that is actually permanent. Watch this video if you want to see the other side of the high-frequency trading world, not the massive multi-strategy quantitative engine, but the proprietary trading firm where a single algorithm can corner an entire market in seconds. Your life as every level of a prop shop developer.